The change will not come with a siren. There will be no emergency broadcast. No formal declaration that the rules have shifted. No headline that says the system has quietly crossed a line. You will wake up to ordinary numbers, ordinary markets, ordinary language, and something fundamental will already be different. If monetary systems fail, why do they rarely announce it? If structural shifts are so significant, why do they appear so administrative? If control expands, why does it feel procedural rather than dramatic? Because systemic change is not declared. It is implemented. This is not about a sudden collapse. It is about how modern financial systems adapt to stress, without acknowledging fragility. Monetary decay in advanced economies rarely unfolds through visible breakdown. It progresses through policy adjustments, regulatory reinterpretations, liquidity facilities, and technical reforms. Each step appears isolated. Together, they redefine the system. To understand why it will not be announced, it is necessary to begin with how money operates today. Modern money is credit-based. Currency is issued against debt. Commercial banks create deposits when they extend loans. Governments finance spending through bond issuance. Central banks influence liquidity by adjusting interest rates and purchasing assets. This architecture expands purchasing power. It also embeds leverage into the foundation of economic activity. Leverage amplifies growth. It also amplifies vulnerability. When debt levels rise faster than productive output, imbalances accumulate. These imbalances do not produce immediate collapse. They produce sensitivity. Sensitivity to interest rates, sensitivity to liquidity, sensitivity to confidence. Confidence is the invisible variable. Confidence cannot be legislated, it must be maintained. When confidence weakens, policymakers intervene. Intervention is framed as stabilization. Stabilization requires flexibility. Flexibility often means altering rules. These alterations are rarely presented as structural transformations. They are described as temporary measures. Temporary measures have a tendency to persist. During the 2008 financial crisis, central banks introduced extraordinary liquidity programs. Asset purchases expanded balance sheets to unprecedented levels. Interest rates were reduced to near zero. These policies were described as emergency tools. Many remained in place for years. The system did not collapse. It adjusted. The adjustment redefined the boundaries of monetary policy. Few recognized at the time that the scale of intervention represented a new era. There was no announcement declaring a transition into permanent balance sheet expansion. It simply continued. Sovereign debt levels increased significantly in the aftermath. Governments relied on low rates to finance deficits. Markets adapted to continuous central bank presence. This adaptation normalized intervention. Normalization alters expectation. Expectation shapes valuation. Valuation sustains asset prices. Asset prices support collateral. Collateral underpins credit creation. Credit creation fuels economic continuity. The loop becomes self-reinforcing. But reinforcement requires maintenance. Maintenance requires policy discretion. Policy discretion expands quietly. Consider negative interest rate policies adopted in parts of Europe and Japan. For centuries, interest represented compensation for deferring consumption. The concept of charging depositors to hold funds was historically abnormal. Yet negative rates were implemented without dramatic announcement of systemic redefinition. They were presented as technical adjustments. The principle shifted. Deposits became liabilities with cost. The announcement was administrative. The implication was profound. Late realization emerged gradually. In inflationary environments, central banks tighten monetary policy. Interest rates rise. Liquidity conditions contract. Debt servicing costs increase. Governments, corporations, and households adjust slowly. Strain accumulates incrementally. When strain becomes visible, policy may pivot again. Pivots are described as data-dependent. The structure adapts once more. The public perceives cycles. The underlying architecture evolves. It will not be announced when structural dependence deepens. It will appear as regulatory refinement. Bank capital requirements are recalibrated. Liquidity coverage ratios are modified. Risk weightings are adjusted. Each modification responds to stress. Collectively, they reshape banking behavior. Banks adjust lending standards. Credit availability tightens. Asset markets respond. The shift feels cyclical, but beneath the cycle lies a ratchet effect. Emergency tools become baseline expectations. Temporary programs become permanent facilities. The mechanism gap widens here. How does systemic fragility grow without public acknowledgement? Because fragility is absorbed into complexity. Modern financial systems are layered with derivatives, repo markets, shadow banking networks, and cross-border funding chains. Stress in one segment can be contained through liquidity injections or regulatory coordination. Containment prevents visible rupture. Containment increases interdependence. Interdependence raises systemic importance. Systemic importance justifies expanded oversight. Oversight increases institutional authority. Authority expands quietly. Shadow banking illustrates this dynamic. Non-bank financial institutions engage in credit intermediation. They rely heavily on short-term funding markets. During stress, these markets can freeze rapidly. Authorities respond by extending liquidity support beyond conventional banks. Support expands jurisdiction. Jurisdiction broadens the perimeter of central bank influence. This expansion is rarely announced. It is framed as stability maintenance. Over time, the boundary between market and state blurs. The consequence gap emerges. If interventions continue to grow in scale and scope, what happens to market discipline? Market pricing increasingly reflects expectations of policy response. Risk is socialized indirectly. Profits remain privatized. Losses may be absorbed collectively. The shift does not occur overnight. It unfolds across crises. Each crisis leaves behind new tools. Each tool expands discretion. Discretion reshapes incentives. Incentives guide behavior. Behavior determines capital allocation. Capital allocation defines economic structure. The transformation is subtle. Digitalization adds another layer. Payment systems migrate toward real-time settlement networks. Central bank digital currency discussions accelerate. Financial surveillance capabilities increase under the justification of combating fraud and illicit finance. These measures are rational responses to technological change. They also centralize transaction visibility. Visibility enhances monitoring. Monitoring enhances control. Control is not inherently oppressive. It is stabilizing from an institutional perspective. But stability and autonomy are not identical. As digital money becomes dominant, the capacity to influence transaction flows increases. Conditions can theoretically be attached to funds. Limits can be imposed swiftly. Such capacities are introduced gradually. They are discussed as modernization. Modernization reframes authority. There will be no moment when an announcement declares that money is now programmable at scale. It will appear as incremental feature updates. Incremental changes redefine baseline assumptions. Consider capital controls historically imposed during currency crises. These measures restrict cross-border flows to protect reserves. In advanced economies, capital mobility is often assumed permanent. Yet during extreme stress, even advanced economies have considered transaction restrictions. The discussion occurs quietly within policy circles. The public hears only fragments. By the time measures are enacted, the decision is presented as necessary. Necessity supersedes debate. The system continues. It will not be announced when trust begins to erode. Trust erodes before prices collapse. Inflation can persist for years before triggering visible currency crisis. During that period, purchasing power declines gradually. Savings lose value incrementally. There is no ceremony marking the transition from stability to erosion. It happens through arithmetic. Interest on savings lags inflation. Real returns turn negative. Debt burdens increase in real terms. Households adapt slowly. Adaptation feels voluntary, but it is shaped by policy. Credit becomes more essential as real wages stagnate. Dependency increases. Dependency reinforces leverage. Leverage increases fragility. Fragility requires preparedness. Preparedness requires intervention capacity. Capacity expands discreetly. The final closure of the mechanism gap rests on one recognition. Monetary systems rarely collapse through sudden declaration. They transform through accumulation. Accumulation of debt. Accumulation of intervention. Accumulation of complexity. Each addition appears technical. Collectively, they alter the foundation. The consequence gap resolves not in panic, but in normalization. New baselines form. Central bank balance sheets remain elevated permanently. Government debt ratios stabilize at higher levels. Private sector leverage becomes structural rather than cyclical. Financial repression may emerge subtly, with interest rates held below inflation to manage sovereign debt burdens. This is not announced as repression. It is described as supportive policy. Supportive for whom depends on position. Institutional asymmetry persists. Institutions anticipate shifts through internal modeling and policy coordination. Individuals experience shifts as gradual change. By the time recognition arrives, adaptation has already occurred. The system does not need to declare transformation. It relies on incremental acceptance. It will not be announced when the boundary between public and private finance narrows. It will not be announced when liquidity backstops become permanent. It will not be announced when intervention expectations become embedded in asset pricing. It will appear as continuity. Continuity masks evolution. Evolution redefines structure. Structure shapes outcomes. The ending is not dramatic. It is procedural. A new regulation published in technical language. A revised liquidity facility extended indefinitely. A risk framework adjusted quietly. Markets open the next day as usual. Most participants continue operating. The system functions, but the rules have shifted. And they shifted without declaration. This is how monetary systems change. Not through proclamation. Through persistence. Through adjustment. Through silent accumulation of authority and obligation. By the time it feels different, it has already been different for years. And no one ever announced it.